All right, let's plug into the latest quarterly report from one of India's energy giants, Tata Power. On the surface, the numbers look pretty strong. But when you start to dig a little deeper, you find this really fascinating story of a company that's just powering ahead with green energy, while at the same time, it's battling some very, very old ghosts. So let's break down what these numbers really mean. Okay, so let's get our bearings here. We're looking at the Tata Power Company Limited. These guys are a cornerstone of India's power sector. Their operations cover the whole spectrum, everything from traditional coal plants to really cutting-edge renewable solutions and these huge distribution networks. What they do literally keeps the lights on for millions of people. And this headline from TradingView, it just sets the stage perfectly. It really captures this central conflict in Tata Power's story right now. You've got this impressive future-focused growth on one side, and then this significant legacy problem dragging things down on the other. It's that exact tension that we're going to unpack today. So to really get to the bottom of this, here's how we'll break it down. We're going to start with those big headline numbers. Then we'll dive in and find out where that growth is really coming from. After that, we'll look at the challenges, the headwinds, run a quick financial health check, and then wrap it all up by looking at what the future might hold. All right, first up, the headline numbers. Let's get straight to the bottom line with the key figures from their latest quarterly report. Now, remember that headline about 12% growth? This is where the story gets really interesting. See, that growth was in their core earnings, what they call EBITDA. It's a good measure of how the main business is doing. But when you look at the final number, the actual profit after everything is paid for, well, it was almost completely flat compared to last year. And that tells us that while the core business is growing strong, something else is eating away at those profits. Let's find out what that is. So if that net profit is flat, where in the world is that impressive 12% earnings growth actually coming from? Well, to figure that out, we have to look inside the company's different business segments. And wow, this table makes it crystal clear where the power is. Just look at those numbers. Transmission and distribution and renewables are the undisputed heavyweights here, each bringing in over 1,100 crore rupees. Everything else? A very, very distant third. And this chart just visualizes it brilliantly. Look at the scale of this shift. When you combine the profits from renewables and distribution, they absolutely dwarf the contribution from the traditional thermal and hydro businesses. This isn't just a small change, you guys. This is a fundamental transformation of where the company's value is coming from. So it's really crucial to understand that renewables isn't just one simple thing. It's a whole ecosystem. We're talking about massive wind and solar farms, rooftop solar for our homes, a growing network of EV charging stations. They're even manufacturing their own solar parts. It is a fully integrated green machine, and it's firing on all cylinders. And inside that massive transmission and distribution number, the report specifically calls out how well their networks in the state of Odisha are doing. This just goes to show that their strategy of modernizing and efficiently running these power companies is really paying off in a big way. But as strong as that green growth is, it's not all smooth sailing, not by a long shot. The company is navigating some pretty significant and costly challenges that are holding back its overall performance. The first and honestly the biggest headwind is the Mundra power plant. You got to think of it like a financial anchor. This massive coal plant has been bleeding money for years because of pricing issues, and yep, this latest report confirms those losses are still weighing the whole company down. In fact, the situation got bad enough that the company actually had to temporarily shut the plant down last year just to deal with technical issues. So this isn't just about financial losses anymore. It's about real operational challenges at one of their biggest assets. And then there's a completely different kind of challenge, a major legal one. This quote, pulled directly from the fine print of their financial report, introduces a huge arbitration case that has gone against the company. And here is the financial sting. The tribunal has ordered Tata Power to pay nearly $500 million, with a B, US dollars in damages. This takes an abstract legal case and turns it into a very, very concrete and substantial financial risk hanging over the company's head. Now, it is important to note that Tata Power is fighting this ruling. Their lawyers believe they have a really high chance of winning on appeal, and that's why they haven't set aside any money for this massive award and their current financial statements. It's a high-stakes variable for their future, for sure. Okay, so with this mix of strong growth engines on one side and some pretty serious financial headwinds on the other, it's a good time to pop the hood and take a quick look at the company's overall financial health.
First up, let's look at the debt-to-equity ratio. It's a classic health check that tells us how much the company relies on borrowed money to run its business compared to using its own funds. A higher ratio usually means more leverage and a bit more risk.
And the trend over the past year is pretty clear. It's been steadily increasing. Now, this isn't necessarily a red flag on its own. You could call it the cost of ambition. It shows us that to fund that powerful green growth engine, the company is taking on more debt. The real key is whether the profits from those investments will grow even faster.
Next, let's check their short-term health with something called the current ratio. This basically asks a simple question. Does the company have enough easily accessible assets to cover all the bills that are due in the next 12 months? We do see some modest improvement here, which is good, but the ratio is still below 1. That means their short-term bills are still greater than their easily accessible assets. It's not a crisis, but it tells us that managing that day-to-day cash flow has to be a top priority for them right now.
So, let's put it all together. The powerful growth, the legacy drags, and this financial balancing act. What's next for Tata Power? Well, they are definitely not standing still. The report notes that right after the quarter ended, they went out and bought another transmission company. This sends a really clear signal that they plan to keep doubling down on their high-performing areas, like that transmission and distribution business we saw earlier. So, the crucial point, and really the big question this whole report leaves us with, is a simple one. Can the incredible momentum from their new green growth engines generate enough power to finally outrun the persistent drag from these legacy challenges like Mundra and that massive arbitration award? The answer to that question is going to define Tata Power's journey for the next few years.